it has been interesting to see this higher march in rates, but it doesn't seem to be having a very consistent effect on the market psyche. What's your take?
I think that's right. I think we need to zoom out a little bit and remember that monetary policy does act with, quote, long and variable lags. What I would say is the alchemy of very, very low interest rates is truly having an impact. We're seeing it every single day with individual pieces of data, whether that be credit card delinquencies increasing or subprime auto delinquencies increasing, or even on the previous segment, right? Companies coming out and having to cut forward-looking earnings estimates or dividends as a result of higher rates. We as consumers, governments, corporations have gotten used to very low financing. There's a very real cost to debt today, and it is having a bite, but it is taking longer for us to get to that end place.
And Jeremy, I'm interested to get your take as well. Listen, some are looking at this Fed messaging higher for longer. We look at the yield of the benchmark 10-year, we're now over 4.6%. What is your take on the economy here in the near to intermediate term? Are you in that soft landing camp?
Yeah, we definitely are surprised. I mean, we were in the camp of thinking you would see more impact. You'd see some negative payroll prints because of these higher rates, but you just haven't seen it. And so you have to say, perhaps the Fed is not as tight as you thought, or that the sort of neutral rate is a little bit higher than you might have thought earlier into the year. So the big question is now, how high for how long? Basically, maybe you get one more hike, maybe you get two hikes. We actually think they don't need to hike more. We have some alternative inflation data using alternative shelter that says, hey, inflation is basically right at their target if they put real-time data in the housing market. But they're not looking particularly at that data set. They're looking at their own numbers. But that number will come down next year. And so then the question is, when will they start pivoting towards lower rates? And will it be next summer or later? But they're keeping this message of higher for longer, and that's one of the things the market does have to confront.
And Jeff, we're going to be flying blind, and so will the Fed for a little while here if the government shuts down, because we're not going to be getting our reports on things like jobs and CPI in a very timely fashion. But you did say in your notes to us that the government shutdown is more noise than news. Is that the market doesn't seem to be reacting that much? Will it react, if it does shut down on Sunday?
I think there'll be a little bit of a reaction, but what we've seen from the past is this is just the government cycle. This is just how things get done. I wouldn't say I agree with it, but it's just how things get done. And what we've observed from the past is these shutdowns tend to be relatively short-lived and therefore have a very muted impact on true underlying economic conditions. So I think regardless of if we come in next week and the government is shut down or not, really all eyes need to be forward-looking. If this shutdown lasts for much longer than we expect, which it absolutely could, again, given just the constraints of higher financing costs and overall government interest payments increasing as a matter of fact where we are just given today, that if it continues much longer than we expect, it will bleed through in a much more significant real way. I would expect if we end next week with the government still shut down, that's really where you would probably start to see a hit to sentiment and investors really begin to take note.